Welcome to Slackin' Off with Brady Slack.
Welcome to another episode of Slackin' Off. I'm your host, Brady Slack. And today's conversation, I'm actually kind of excited for. Now, I'm going to preface, before we get into the introduction, Kevin, I'm going to preface some things, okay? Today we're going to talk about retirement accounts. We're going to talk about retirement funding. We're going to talk about the different kinds of retirement accounts. And I want to put an emphasis on their importance. Now, for all intents and purposes, they typically, for my clients, are not a first or second choice option when it comes to tax planning. Um, there are other things that just by nature our clients are doing that make a little bit more sense with their tax plan. However, I think that there is a good use for retirement accounts, 401ks, IRAs, and we're going to dive into that. But without any further ado, Mr. Kevin Lau, thank you for hopping on and helping us understand this concept today.
Happy to be here, Brady. Thanks for having me.
Well, it's a pleasure, and thank you for returning the favor. We had a great conversation on your podcast, which I'm excited for that to be released, so that it'll be a good tandem there. But tell the audience a little bit about yourself. You're a financial advisor. Are you an RIA? Do you work with a big box firm? Tell us a little bit about maybe some of the background and how you found your way into this position you're in today.
Yeah, that sounds good, Brady. So, background. So, I started in the industry in 2008. Really, very interesting time to get into financial services. So finance major in school, and like I remember my finance professors were like, they weren't sounding the alarms to us, but you could tell like they were like, what is happening in the
Yeah.
financial markets right now? And sort of as a senior, like looking to get my first job, I was just looking to get out there, get some experience, work for a big bank or maybe a Wall Street firm, get some experience with invest in the investment world. But no one was hiring. Like they were all worried
Yeah.
about their own jobs. They were kind of going through the motions on campus, just doing the interviews, but they were worried. So I sort of backdoored into the industry through a kind of a non-traditional route, selling insurance for one of the
Okay.
big four insurance companies, right? And sort of what got me into there is I was at a career fair and I had a couple of buddies that were like, "Hey, you need to go check this out. I think you would be good at this." And really, what got me into it, what sold me, was the managing director at the time stood up and did a little powwow, sort of selling the career. And he said, "Hey, there's 50 of you here today. In 5 years, there's only going to be one of you." And I
Hmm.
was just like, whatever reason, I was like, I like that. I like I like the exclusivity of it. I like that it is hard, and so I just kind of like ran with it, honestly, because no one else was hiring, and it was 100% commission job with the opportunity to make some money out of college. And honestly, after that first year, I made more than all of my friends that got regular jobs. You know what I mean? So I was
Yeah.
like, all right, this is interesting. But after 3 years, so I furthered my education. I got my CFP, Certified Financial Planner, and the head of the program kind of changed my perspective a little bit. And was like, "Hey, Kevin, if you really want to sit with clients and advise on their retirement and advise on their business and advise on their financial future, like you got to sit on the same side of the table as the client. And like right now, you're just kind of slinging insurance products or annuities or
Yeah.
mutual funds. And it's like, is that in the best interest of the client, or is that best for your pocketbook?" And it kind of like, as a 25-year-old, when I first did the course, I was just like, "Oh my gosh!" Like I thought in my mind, like I was doing well, like I was making top 10 in my in our agency, and it's like, everyone was like, "Oh, Kevin, you're going to just build this amazing business," but I was like, I just don't know if this is the place I want to do it, right? And so it kind of was like this 8-year period of trying to figure out what is the best way to go. And so I spent 6 years there at that big four. Such a phenomenal experience. Like I love the people I met there and the training that I got. And then I spent the next 6 years working for a more traditional wealth management firm and cutting my teeth on traditional retirees or business owners that were selling their business and transitioning into retirement. And kind of just a quick fast forward, during that process, the COVID happened, and technology at that firm was just awful, and like servicing
Mm.
clients and trying to communicate with clients, like I was like, is this like, what is going on here? And I had this thought in my mind of like, hey, I'm entrepreneurial. I wanted to start my own firm at some point. I didn't know if it was going to be at the height of the pandemic and while we had 3 kids under the age of 2, but that's what we did in 2020, November of 2020. We launched our own firm, Imagine Financial Security. So we cut out all the big broker dealers, the insurance companies. We don't sell products for anyone else. clients hire us. We advise on that for them, with regards to their retirement planning, and we can sit on the same side of the table without those conflicts of interest. So it's been a journey, you know what I mean, growing the business with three young boys, and my wife's, she helps a little bit in the business, but she's also caring for the kids full time, which is a lot more hard, a
Yeah,
lot more
she's got a
difficult than what
full-time
I'm
job
doing on a day to
herself.
day basis. Yeah, exactly. So, anyways, but no, we're good, man. We're survival mode, and super excited to chat with you more today about retirement planning.
No, that'll be good. So when I was in school, I was a double major, studied accounting and personal financial planning, and I had a really great professor teaching us financial planning. And I'll never forget. I don't know that I will ever forget this slide that he put up one day, and it was a scale, and it went from green to red on the different professionals in financial services. And on green it was like your traditional tax advisor and your financial planner, and then all the way on, and there were some things in the annuities and things like that. And then on the far right, red was life insurance sales, and there are like life insurance is important. We've had a couple conversations on other podcast episodes about it. But there's a couple, but it gets a bad rap, And so
Yeah.
all that being said, today I did want to focus on retirement plans. With I mentioned a little bit before, prefacing before we got into your intro, Kevin, that a lot of our clients, when we do tax planning with them, we'll talk about the real estate, we'll talk about the oil and gas, we'll talk about the energy. But at the end, at some point, there's always kind of these, uh, this is bad. I'd refer to them as bottom feeders. There's always
Mhm.
low hanging fruit that we
Yeah.
can take advantage of. And in my opinion, those are things like a solo 401k,
Yeah.
like a SEP IRA. You mentioned before we started recording a defined benefit plan.
Hmm.
Maybe combining some of those with a potential Roth IRA and doing a conversion. And those are the
Hmm.
kinds of things that I want to dive into, only because, like I said, I feel like those are low hanging fruit that most, if not all, business owners could take advantage of,
Yeah.
put some money away, and allow themselves to grow that little nest egg for themselves.
Yeah. Yeah. I think that's great. And I think, and we talked about this yesterday on my podcast, where it's
Yeah.
like, I feel like the way I advise clients, it's very different than a traditional advisor. And I think it's partly because of the fee structure that we have. The
Yeah.
traditional financial advisor, how do they charge? A percentage of the assets under management, right? We don't
Yeah.
do that. Okay. We're a flat fee firm. So our fee is transparent, it's out there, and that's what the clients pay us, regardless if they have $5 million with us or $7 million with us or $1 million, right?
Yeah.
And so I think that allows us to sort of say, hey, we actually do believe in non-traditional investments, right? As an entrepreneur myself, like, I understand and recognize the best investment that anyone could make, that who's a business owner, is back into their business. Like, you just
Yeah.
can't get the multiple rates of return you can
No.
get on business valuation and growing your business. So that's obviously number one for your listeners and your clients as well, Brady, is that business valuation. And then number two, we talked about real estate, which I would also look as a non-traditional investment vehicle. We're not talking about REITs or real estate investment trusts that you buy in a 401k plan or
Yeah.
or a brokerage account. We're actually talking about going out and buying multifamilies, or getting into commercial real estate. And some of our clients will do that actively. Like, they'll actually go out and hire a realtor or an investor or partners and go out and buy these properties themselves. Sometimes they do it more passively, and so we can talk about that. But that third component, of the core four, is what I like to call it, are these traditional retirement vehicles, which essentially, for our business owner clients, just allows them to take some of the chips off the table, get some tax benefits, some of them today, some of them in retirement. And we'll talk about, what makes the most sense for certain clientele, but reaping those tax benefits so they can take some of those chips off the table. And so when they transition to go to retirement, which for a lot of our business owner clients, that doesn't mean just like sitting around and doing nothing. Oftentimes it's like, hey, I'm going to retire and kind of do something else. You know what I mean? Do
Yeah.
other passion projects or stay involved. A lot of my clients are busier now in retirement than they were when they were running their companies, And so it's like, you
Yeah.
know, these are people that are not going to just hang back, but it's like giving them the financial flexibility to say, hey, we're kind of building the business, we're building our real estate portfolios, but we're also building this more kind of this traditional method of investing that's, I'm not going to call it guaranteed, because we know the stock market and these types of
Sure.
investments are not guaranteed, but a well-diversified portfolio has a very high degree of confidence of achieving a desired rate of return, and that resonates for a lot of our business owner clients, knowing that they have some safe money that's not tied up in their business ventures.
So I want to there was 2 points here that I kind of want to touch on really quick. Um Fee basis percentage costs when looking for a financial advisor. I personally believe there are pros and cons to both,
Mhm.
but eh, in my opinion, a percentage based fee is probably going to be more applicable for someone who is high net worth. There's probably a little bit more risk. There's a little bit more involvement on the assets. That is where I think
Mhm.
uh, uh, a percentage based fee, it makes sense. Now, a flat fee billing makes sense for someone who might not be high net worth. I guess, correct me if I'm wrong, but
Yeah,
what are
it's
your thoughts on that?
well, I guess what's the like what is your rationale on that? I'm just curious to hear before I give my answer.
Um, I guess my only rationale behind that, based on the experience that I have, which mind you is not as
Mhm.
much as you do, but my only experience with that is when we do have higher net worth clients, they're not throwing money in the market to stay safe. They're throwing money in the market to grow, and they
Mhm.
want high growth.
Yeah.
And with that comes someone who is going to actively manage the portfolio a little bit more, and it would make a little bit more sense for that individual to be making some sort of percentage on the assets under management, assuming that there is growth in the account. That's really my only thought process there.
Yeah, I think there are two different types of flat fee advisors. There are flat fee advisors that are just basically giving advice only, right? So I'd call them the advice only camp, where so you can actually hire a financial advisor without handing over any assets to manage. Okay, which is kind of unique and pretty cool for a lot of business
Sounds
owners
more
that
like
may
a
not.
review. They're
Yeah,
basically
exactly.
reviewing and advising.
Yeah, just like, hey, like,
Hmm.
let me just get some confidence on like, hey, if my business turns out the way I expect it to, and I sell my company in let's say 5 years or 10 years, what else do I need to have on top of that to complement that? Whether it's real estate or traditional 401ks, et cetera. And advisors can go out and actually review and run some analysis and talk about tax planning and opportunities that most likely that entrepreneur may have thought of, but may not have been able to say, hey, how is this applicable to me? Okay. There are other flat fee advisors like my firm that actually do the advice and planning, just like we talked about, as well as take over the management of the assets. And
Okay.
it's very, for me, I have no problem with the percentage of the assets model. I used to work under that model at my previous firm, but I like the idea of the flat fee billing, okay?
Sure.
Because over time what's going to happen is that things change, right? A client may need a large distribution because there is an investment opportunity, just because they're
Mm.
retired doesn't mean they're stopped building wealth, right?
Yeah.
Maybe there's an investment opportunity to say, hey, I want to take out 300 grand to go buy a rental property. I had this conversation recently with a client, and I was just thinking in my mind, I'm like, not that a percentage of asset advisor would recommend against it, but there's a conflict there,
There's a
because
conflict.
that's
Yeah.
what they're getting compensated on how much money is under management, not necessarily providing the best advice for the client. Well, guess
Fair.
what? That client that I was talking about, I recommended she take 300 grand out of her portfolio to go buy that investment property
Yeah.
that she'd
Fair.
been looking for, right? So in addition to that, I just like the transparency of like, this is how much I'm paying my advisor to do whatever services that they're providing. And so I think the percentage of asset model, I would actually kind of counter and say I think it's the opposite. I think the
Mm.
higher the net worth, the more the flat fee billing makes sense. And then the lower the net worth, because most of the flat fee advisors that are doing really good comprehensive planning, inclusive with investment management, it's actually better for someone who has maybe a smaller net worth, maybe under a million, to hire a percentage of asset
Percentage.
advisor. You know
Fair.
what I mean? Because a lot of
Yeah.
times they're doing more of the churn and burn. They have a large quantity of clients. We target a very specific, clientele. Not ultra high net worth, but high net worth 2 to 10 million. And we find that's a wonderful sweet spot for the
Sweet
flat
spot.
fee, inclusive of investment management and planning.
Fair. No, and I see your point. That no, it is a good point. Again, I think it's fair. The other thing you talked about, which I don't want to spend too much time on, and it actually comes from something that I'd heard at a training I was at last week. Uh, the comment that was made at this training that I was at last week when we were talking about some paper assets and some
Mhm.
tax consequences of those paper assets was diversification allows an individual to not lose, but diversification does not allow high growth. What are your thoughts
Yeah.
on that?
Yeah. I mean, define high growth, right? I mean, are we talking 20% a year annualized returns? Or are we talking 10% a year annualized returns?
So the context of the conversation, we were speaking
Hmm.
particularly about paper assets. So I don't think that
Okay.
would include growth in a business or growth in real estate, which one could
Hmm.
argue is potentially higher than a paper asset, right?
Yep.
Like you talked about earlier. But I think growth could be relative. Average maybe 8 to 10%, give or take.
Sure.
So the more diversification you have, one could argue that maybe growth exceeding that 8 to 10% is going to be harder to obtain. Thoughts?
The S&P 500, I would consider that to be pretty well diversified, and that's annualized 10% over inception. If you look back into the 20s, right? I mean, so that's pretty well diversified. You have over 500 companies in a well diversified portfolio. If we're talking diversification from an asset class perspective, absolutely, you're going to sacrifice some
Yeah,
upside because most people would say yes. Obviously, the S&P 500 has done 10.5% on an annualized basis, but once they get closer to retirement, or maybe they've retired, they've accumulated enough wealth where they can easily live on that for the rest of their life. They just don't want to lose a
yeah,
large chunk of money in their portfolio. So they're not trying to bet on crypto or high growth assets at that point. It's more of preservation and inflation protection. And so we need
yeah,
stocks, equity exposure to protect against inflation, but oftentimes introducing other asset classes like fixed income or a fixed income alternative, or real estate in the portfolio, or small caps, even international stocks. So absolutely, once you introduce more asset classes, the chance of losing money goes down,
goes
but
down.
the opportunity for more returns, of course, goes down as well. So it's
Great.
risk reward trade off. And I start with what is the goal? What's the end in mind? Let's kind of begin with the end in mind, right?
Yeah,
What is the ultimate goal? Are we trying to hit a home run from here? At age 60, you just sold your company. Do you want to hit it? You want to try to go for another home run? Or are we trying to hit some singles and doubles to enjoy, kind of ride off into the sunset of retirement and leave a legacy to your family? What is important? And I'm
yeah.
not telling anyone what their goals are. I want to understand what's important to them and then design an investment policy statement that's aligned with that.
Great insight. No, that was along the lines of I think the conversation and how that went at that training. But that was a great explanation, and I think it's important for people to remember that singles and doubles still help the batting average, like that.
Yep,
You know,
absolutely.
so
You need some small
um,
ball every once in a while.
yeah, I mean, you can get on base. Now, so this is where I want to dive into kind of the premise of the conversation. Uh, Typical client of ours, small business, consider them small business, even though their businesses might be doing 5, 7, 10, 15 million, right? Small business,
Hmm.
um, as defined, they've got some additional money. They've got maybe a couple individuals in the business operating. That might include husband, two spouses, maybe some kids. Let's talk about retirement accounts. They and again, mind you, this is the diversification part of this conversation. At this point, they have other high growth opportunities. They're making
Hmm.
money in their businesses. They have a real estate portfolio, but
Yep.
they've got some additional money. There's some low hanging fruit that we could still take advantage of. Typically, with our clients, this is where we're talking maybe a solo K, maybe a SEP
Hmm.
IRA. You mentioned defined benefit plan. When would any of these accounts make sense? When would they maybe not make sense?
Yep.
And what I think people are losing out on the opportunity by not taking advantage of them, but give me a little insight. What are some of your thoughts? And we can go down this rabbit hole.
Yeah, so I mean, if we had this conversation 5 years ago, and we said, we were talking about what is the most popular investment or retirement plan for a small business, it would have been the SEP IRA. The simplification of opening the accounts and sort of the adoption agreement is very simple, and the annual compliance maintenance is very simple. And so, and the SEPs, they allow for some decent contributions. Essentially up to 25% of income. And so, a business owner that's making, a couple hundred grand a year or higher, they can contribute up to that. They could probably cap that out pretty quickly,
Yeah.
with a SEP IRA and just get that money in pre-tax. Now the downside of the SEP is once you start adding employees, it becomes a little bit more complicated. Okay, so if you're a solopreneur, okay, like myself, or maybe your spouse works with you, you're good with the SEP IRA.
Yeah.
But once you start to onboard other
Hire
employees. It becomes a little,
admins,
yeah. And
operators.
yep, you've got to include them in the plan, and the percent contribution has to be uniform
Equal.
across the board, right?
Yeah.
And so, this is where some people will then say, hey, maybe we hired a bunch of 1099s or contractors. Well, it's a pretty competitive labor market. And so,
Yeah.
you've got to if you want to attract and retain good people, you've got to have some kind of retirement plan. Your employees are not business owners, okay? That's why they're employees. That's why they work for you. And so, oftentimes the reason business owners will set up some kind of qualified plan, a retirement plan, is to reward the people that are working hard to build your business, right? And
Bingo.
so, oftentimes, yeah, the tax benefits are great. You can make the contributions, get your taxable income down while your income is high. All of those are true regardless of what qualified plan you choose, unless you go Roth, which we'll talk about that as well. But it's about attracting and retaining good people who are going to continue to help your best investment, which is your business. But if we fast forward now 5 years, sitting here in 2023, I would say the most popular retirement plan for my self-employed individuals without employees would be the solo 401k. And this plan just allows for higher contribution limits. You can also have your spouse on your
Yeah.
on your payroll, have them set up a solo K as well. That doesn't necessarily count as another employee, so you don't need to set up a regular 401k plan. And then sort of this adoption of these after tax mega Roth backdoor contributions. It's a very powerful tool from a planning perspective and a tax perspective that a lot of my clients are choosing to go the solo 401k route that don't have full-time employees on their staff.
Now, before we go any farther, one thing that I think it's also important to discuss really quick, I've seen where a client will set up a SEP or a solo K. They'll fund that solo K or that SEP, but the account is utilized like a bank account and the assets are never actually invested.
Hmm. Yeah.
And I think there's kind of these 3 or 4 steps: the qualifying factors, getting the plan set up, funding the account, and then what you actually do with that account, right?
Yeah.
2 or 3 minutes on why that's important to make sure that the accounts are invested, and who might you recommend? I'm teeing you up, but who might you recommend make sure that those funds are managed and invested?
I see this all the time, and not even with just business owners, with just people that are contributing to their
Yeah.
401k. This has led now to most plans. They'll have like an auto enrollment into some kind of target date fund. Like if someone is 40 years old, they'll auto enroll them into, like, let's say, a 2050 fund or 2040 fund. But no, absolutely. If you set up a SEP IRA or a solo K, it is up to you to get that money invested. So step one, picking the right plan, and then number two, picking the plan provider and opening the account. Number three would be to fund the account. And depending on what plan you choose, the timing will be a little different. And then number four would be to actually get the money invested in the
Hmm.
account. And I recommend for my business owner clients, let's get things automated and streamlined. Whether it's payroll contributions, doing a solo K,
Yeah.
or with the SEP IRA, it's more you got to wait until tax time because you need to know what your income was for that calendar year previous. And so just creating some kind of system and process to get the money in the account, and then more importantly, to your point, getting the money invested. And this kind of comes back to what we just talked about before, which is, just, you don't need to get super complex, with your investment strategy within a qualified plan. Like, this is meant to be kind of your boring asset class.
This is the diversification that's just
Yeah.
going to be the nest egg that slowly grows so you
Yeah.
have something.
Yeah. So if you're picking, if you want to just keep it super simple, you could pick an S&P 500 fund if you want to. But, you might lose out on some other asset classes like small caps. They haven't done so well over the last year. Smaller
Yeah.
cap, firms. So they're minus 7% over the last 12 months. Whereas if you look at the Nasdaq and the tech sector, they're positive 30% year
Mm.
to date. The S&P 500 positive 18%. So I teach my clients sort of the opposite of what we're trained, which is we want to be consistently buying the losers, buying low, and selling, taking some of the gains off the table with the winners. And right now, the losers have been the small cap, mid caps, because higher interest rates, higher for longer. It's tougher for them to
Yeah.
get money, get funding to grow their businesses. So they're being squeezed. Whereas the bigger companies, it's not as concerned. They have dry powder, they have the capitalization to weather the storm as long as they're well funded. And so we've seen kind of this rally so far in 2023, more on the larger side, of the capitalization structure, whereas the small caps, I think there's so much opportunity. If we look 5 years down the road, I think we're going to see a significant run in the small cap sector, and then international as well. We could also talk about international all day long. They've been the losers over the last 13, 14 years since the Great Recession. But valuations are more attractive overseas in general. And we've got sort of this situation right now in the US with, debt crisis and all the stimulus that we've been given out over the last several years. There is concerns about the US growth opportunity relative to
Yeah.
some of these other countries, but that's neither here nor there. But I think, getting that money invested, getting it well diversified, and creating some sort of system and process so it's very easy to manage, and you're not having to think about this while you're out there growing your businesses.
Um, are the investment opportunities different in a 401k versus an IRA? Because I know contribution limitations are different. Reporting requirements might be a little different, but are the actual investment opportunities going to be different?
They could be. So if you have a 401k plan, not a solo 401k, I'm talking about a 401k plan that, you have other employees in your business and you're offering these 401ks. Typically, you're going to have a menu of options. Okay.
Yeah,
Your plan administrator is going to say, hey, here are the investment options that you have. Choose from those.
gotcha.
And the smaller the business, or if you're trying to cut costs, you probably don't have the entire array of options that you would have if you were to have a SEP IRA or a solo 401k. Those act just like a brokerage account. Okay.
Yeah,
And so my clients that have the solo Ks, we operate under Schwab. We're not employed by Schwab, but Schwab is our custodian. So all of our clients that we have investment accounts that we're managing for them,
through
will set
Schwab.
the account up with Schwab. Or there are some other solo 401k providers that can use the Roth 401k option. Because right now, Schwab just acquired TD Ameritrade, and TD had the Roth 401k for the solo K option, but that's not yet on the Schwab platform. So there are other providers out
Mm,
there that we can utilize still with Schwab, but a different adoption agreement to get that Roth solo K option, which is attractive in my opinion.
interesting. Let's dive into defined benefit plan. Now, before we hit record, you were mentioning, hey, I think it's important to talk about defined benefit. It makes a lot of sense for a lot of people. It is different than your solo K or your SEP IRA, at least as far as what you can fund, but it's also different as far as cost. It is a little bit more
Yeah.
expensive. There's a little bit more reporting that goes into it, but tell us about the benefits and maybe some of the downsides of the defined benefit plan.
Yeah, I would say it's not great for a lot of people. I would say that the folks that are choosing this plan is more in the minority, but when it's a fit, it's like a home run opportunity
Okay.
because the contribution limits are so much higher. Like if we look at, the max contribution, okay, you can make into a solo 401k for 2023 is $66,000. For 2024, or I'm sorry, if you're over 50, that goes up to $73,500. So you can contribute a good chunk
That's a
into a
good
solo
chunk.
K. And that's and a lot of people think, oh, well, 401k, I thought the limit was 22,500 if you're under 50. And then if you're over 50, it's 30,000. That's employee contributions.
Yeah, we're
As a
talking
business
employee
owner,
and employer.
employee contributions, profit sharing contributions,
Yep.
right? Essentially matching. And then those additional contributions, which will be after taxes. Okay. So not all these contributions will be deductible, but those after tax contributions, going back to this mega backdoor Roth 401k contribution, could then be converted into the Roth 401k. So yes, you didn't get a tax deduction for some of those contributions, but they're now inside of a Roth
Now you
401k,
get a
which
tax-free
now
growth.
you have a tax free
Yeah.
bucket here. So yeah, the contribution limits aren't not meaningful. I mean, 73,500 is a meaningful contribution, but with a defined benefit plan, I mean, we're talking several $100,000 that you can contribute for some of these plans because they're based on the age and the defined benefit that you choose in retirement, which is typically the highest 3 years of the compensation of the business owner. And it works so well for the business owners that maybe got a little bit of a later start to saving, and they have a high income, so they have the capacity to save a good chunk of money on an annual basis over and above that 73,500. And the age of the business owner matters because the time until they retire goes into the calculation of how much the max contribution will be for that particular employee. In this case, we're talking about the business owner. So it just allows for a lot more aggressive funding into these plans to essentially create that pension like income stream during retirement for an entrepreneur.
I think this is extremely important because the the worst thing that accountants do, in my opinion, when we discuss the topic of tax planning is they'll say just go buy this or go buy that because you'll pay less in taxes at the end of the year. I mean,
Yep.
really, what you're telling the client is that you don't value the dollar that they earned, and you would rather save them 24 cents than let them keep 76 in their pocket. Like that's really the
Yeah.
conversation, you know?
Yep.
And when we talk about tax planning with our clients, the idea is let's try and do as much as we can that will give us a tax benefit, whether that's a deduction or a credit, but keep that money in my financial sphere. I still want control of that money.
Mm-hmm.
So whether that's paying a kid, an
Mm-hmm.
Augusta rule expense, a defined, a qualified plan like what we've been talking about, the solo K, 401k, defined benefit, like all of those things still keep that money within our financial sphere. Now, we talked briefly about some of the investment opportunities, just barely. What we haven't talked about is the opportunity to maybe self direct some of those
Mm-hmm.
investments
Yep.
into the non traditional investments such as business or real estate. Tell us just a little bit about that. Why would that be
Yep.
something important to consider?
Yeah, I mean, I think it's again, it sort of it goes in, sort of back onto that the top two I mentioned, opening a business, having that business ownership, and then real estate. Some people, a lot of your clients, most likely, want to also take risk within their 401k outside of the traditional investments,
Sure.
right? Um, so self-directing a solo 401k is absolutely an option where you could actually fund a startup. You could fund your business, with the solo 401k. You could buy real estate and sell real estate within a solo 401k. So those options are in there, and certainly when we're talking about diversification, that's got to be part of the conversation, because for a lot of your clients and listeners, the opportunities come up, you know what I mean? And so they don't want to be handcuffed to saying, hey, yes, I want to contribute money in here because it's giving me a tax break today. I get the benefit of providing these benefits to my employees. I get the idea of sort of saving outside of my business or outside of my rental properties, so they want to build up this plan, but they also don't want to handcuff themselves to say, hey, what if an opportunity comes up and and liquidity wise, this is my most liquid asset. They want to have access to that capital, for those investment opportunities. So there is options to self-direct, solo 401ks, just like you would with a self-directed IRA, which is pretty cool.
No, that's good. So we're today filming the podcast. We're November 15th. Got about a month and a half. Now, I think it is important to say that there is still time,
Hmm.
right? There's
Yep.
still time for these business owners, whether you're a client of mine or not,
Yep.
to set up one of these accounts before the end of the year and then be able to fund those accounts by April 15th of next year. We don't even have to fund them by December 31st, but we do have to
Yeah.
have them open, right?
Well, the SEP IRA, we can fund it up until tax time. The 401k plans, we've got to hit those during the calendar year in which you
Okay.
earned the income. Okay. So the SEP IRA, we're good. We can actually open and fund those accounts whenever your clients file
You would
taxes. So
like.
that could be April,
Okay.
that could be October, whatever it is. Once they get that, what is the self employment income? How much can you contribute that calculation? Then they can open and fund that account. Whereas the 401k, we've got to get those accounts open before the calendar year and funded
And
before the
funded
calendar
before.
year.
What about
Absolutely.
what about defined benefit?
Defined benefit, same thing. That's a calendar year
Calendar year.
type of account. Yep.
Okay.
So yeah, there's not
Nonetheless,
a ton of time. There's not a ton of
there's still
time.
time.
There's
There's
still
still
time,
time.
but not a lot. And so there are some actions you can take now to get that going. And so, I love having conversations with business owners just to say, hey, here's my situation. What are your general thoughts? And if there's action that you can take now, great. If not, you can kick the can down to next year. If there's not a whole lot of planning opportunities you can do. But I think the important part is having these conversations now, well before the holidays kind of get in full swing, because
Yeah.
we all know what happens then. But those are great conversations to have before year end.
Okay. No, that's good insight. Now, if people wanted to have that conversation, if they were interested in looking at working with you, Kevin, How can people get a hold of you? Where can they go to find you? And what resources might you also add to that might not be yours for people to get information about
Yeah, I
that?
would say there's some. To get in touch with me directly, I would say my website is a great place to start, which is imaginefinancialsecurity.com. I'm pretty active now. I just started an Instagram handle, Brady, so
Oh,
I'm
very
excited
good.
about that. So you can also follow my Instagram handle, which is also at Imagine Financial Security. And so that's definitely a way to interact with me. You can send me a DM on Instagram or go to my, like I said, website. You can my email and all that good stuff is on there. But yeah, there's a ton of good resources out there. I'm gonna have to think about that in terms of like specific to what we're talking about today. But my solo 401k.net, they have a blog and they have a lot of good information on a lot of the things that we talked about today, but didn't really dive too deep into, like the mega backdoor Roth conversions. So I would check that out. There's a lot of good resources on that website from a blog perspective. So maybe start there and then pivot.
Awesome. Well, Kevin, I appreciate it. Again, like I said, I there was some technicality there. There was some really good ideas. And again, I this is something that I think is important. It's low-hanging fruit and something that people should consider doing, especially in the realm of tax planning with year-end ideas and strategies. So I again thank you, Kevin, for hopping on.
Hey, Brady, thanks for having me.
Absolutely. For those listening, again, we'll have Kevin's information in the show notes. If you have any questions, concerns, you liked the show or did not like the show, let us know. Leave us a comment, and we look forward to having you on next time. Keep slacking off. Thanks.
Thanks for tuning in to Slackin' Off with Brady Slack.